Welcome to this week's episode of Jonathan on Money. This is episode number 172. So, as we reach the midpoint of the summer, I've been reflecting on how this time of year is when people actively try to get into better shape. I've just been seeing a lot of people running and walking and working out. There are more people exercising because it's nicer outside. They're also making effort to start dieting. And as you may have guessed, dieting is something that I can easily tie back to personal finance, which I've been thinking about often over the past few weeks. In fact, I think the lessons from dieting can apply to all of us. First, there's obviously the food diet. I'm not a fan of fads, including juice cleanses, intermittent fasting, or keto, though I support the goal of feeling better and picking a healthy food diet that you can stick with is imperative. There's also a media diet. Dieting's not limited to food. The term can also describe what we regularly consume mentally, emotionally, and socially. The idea is especially relevant when it comes to the news today. There are endless ways to consume world events, including podcasts, social media, television, and conversations with friends. The challenge is that not all sources are reliable, and many are biased or sensationalized. Regular exposure to angry or exaggerated media can leave us less informed, more agitated, and easily irritable. For this reason, I've committed to being more selective about both the quantity and quality of the news I consume. On that point, recently a friend asked me if I watched some interview with Tucker Carlson, and I told him I had not. He argued that it is important to know what is being said about Israel and the Jewish people, and I don't fully agree with his point. Unless I'm actively engaging in debate with propagandists and lunatics, there's little value in consuming content that I believe distorts reality. It is more likely to increase frustration and distract me from more productive or meaningful pursuits. Spending my time on consuming the truth and being a better husband, father, financial advisor, and enjoying life is a far better use of my time. Finally, there's a financial news diet. A similar principle applies to finances. One of the greatest challenges faces is tuning out the noise, and I always end with that every podcast. There's a constant stream of questionable financial commentary that lead individuals and families to make poor decisions. Social media influencers, cable news commentators, journalists, and even financial institutions oftentimes promote ideas that are misleading or harmful. These can include fear driven narratives, unrealistic strategies, promises of quick gains, or short sighted tactics that ignore long term consequences. Recent coverage surrounding tensions with Iran is a clear example of how fear can dominate headlines. While geopolitical risks are real and concerning, they should not dictate your investment strategy or financial plan. It is not possible to consistently predict which parts of the market will outperform, nor is it possible to eliminate all risks. Markets experience periods of volatility for many reasons, and typically the most effective approach is patience. Over time, markets have historically recovered, and well constructed portfolios tend to regain value. Rather than consuming financial content that encourages impulsive decisions or short term thinking, it is far more beneficial to follow sources that provide perspective and emphasize long term principles. This approach leads to better outcomes and greater peace of mind. And remember, friends, you are what you consume. It's always important to remember that we are a summation of everything we feed into our body. This is true with food and information. A smart approach to dieting, whether related to food, media, or finances, is rooted in selectivity, quality, and simplicity. With food, focusing on maintaining just a few consistent nutrient dense meal options can support a healthy lifestyle. With national news limiting consumption to major stories that directly affect your life and skimming perspectives from different viewpoints can help you stay informed without becoming overwhelmed by negativity and conspiracy theories. In many cases, a quick scan of the top stories is sufficient. Avoiding propagandists on both sides of any story is a sensible approach. When it comes to financial news, successful investing does not require constant attention to headlines or daily market movements. It is more useful to focus on financial history instead of forecasts. For example, during the five major U.S. involved conflicts, markets have shown a consistent pattern of resilience. Following World War II, markets rose more than 20% in the first year and achieved strong gains in over 5 and 10 years, driven by post-war economic boom. The Korean War period produced similar strong results with roughly 20% gains after 1 year and a solid long-term growth. The Vietnam era delivered more modest but still positive returns with gains over 1, 5, and 10 years despite inflationary pressures. The Gulf War was marked by sharp decline followed by rapid recovery, leading to strong returns over subsequent decade. During the Iraq War, markets again posted positive returns over 1, 5, and 10-year periods, even with the global financial crisis occurring within that time frame. The point of this whole spiel is this. While wars and other concerning headlines create short-term uncertainty, long-term market performance has remained positive as economic fundamentals prevail. The key is maintaining a good diet of food, news, and with your finances. In other news, don't forget to buy my book, D's for Diversification, available at ABC's of Personal Finance, which is available on Amazon or at jonathanmoney.com. And that's still a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share that my upcoming live full webinar series will be released in a few weeks. And if you or a friend would like to be notified of my upcoming series, you can either go to parkbridgewealth.com/webinars to register to be on my distribution list, or just email me with the word webinar in the subject line to be added to the list as well. Okay, now for today's agenda. My talking points this week will discuss, can AI really answer all your financial questions? Our quote this week is from Richard Nixon on purpose. I'll spend the last half of the episode answering listener questions, including, does getting plastic surgery offer a good return on investment? And finally, we'll end with an actionable idea to implement your investing life, where we'll discuss tax traps to avoid, in particular, why your asset location may be backwards. With that, let's jump into this week's talking points. So AI is still in the news frequently, and the question that continues to come up is, can AI effectively replace a human financial advisor? So we've touched on this before, but let's delve into it a bit deeper. The short answer is no. While AI is a valuable tool, it is far from a complete solution for financial decision making. Understanding where it helps and where it falls short is really critical. First, AI is a useful starting point. To be clear, AI does have real value. I use it myself as a substitute for traditional internet searches. Instead of combing through pages of results, AI can quickly explain financial concepts, summarize articles, and provide historical context, and I use it in other ways as well. However, AI often misses important details. Anyone who has used AI for a more complex financial question will quickly notice its limitations. Responses often sound confident and well structured, but they are not always accurate or complete. In my own testing, I frequently find gaps. Sometimes the answer lacks nuance, other times it overlooks key variables that could materially change the outcome. AI produces information, but it does not truly understand your situation. It relies on general patterns, not the specific context that determines whether a strategy is appropriate. In personal finance, those details are everything. Additionally, personal finance is personal. One of the biggest misconceptions about financial planning is that it is purely mathematical. Numbers matter, but they're only part of the equation. You could present AI with a detailed scenario and ask for a strategy, but it rarely asks meaningful follow-up questions. It does not assess risk tolerance, weigh trade-offs effectively, or understand the emotional factors behind financial decisions. Two individuals with identical incomes and portfolios may require entirely different strategies based on their goals, personalities, and family situations. AI struggles to account for these differences in a meaningful way. It can provide general guidance, but it cannot fully evaluate the human factors that drive real world decisions. Family dynamics, for example, can significantly influence planning decisions. Issues such as inheritance, spending habits, retirement expectations, or supporting relatives require sensitivity and judgment. These are not areas where a generic answer is sufficient. Also, the human element is essential. A major limitation of AI is its inability to interpret human behavior. In conversations with clients, What is not said is often as important as what is said. Tone, hesitation, discomfort, and enthusiasm all provide insight. These cues shape both the strategy and the likelihood that a client will stick with it. For instance, a client may claim to be comfortable with risk yet show visible anxiety when discussing market downturns. Another may express excitement about an investment strategy but become uneasy when considering potential losses. AI cannot observe or respond to these signals. It cannot navigate the interpersonal dynamics that are central to effective financial planning. Experience is another critical component. Financial markets move in cycles, and advisors who have navigated multiple environments develop practical insights that go beyond data. Consider recent history. In 2022, after a significant market decline, many investors were shaken. An experienced advisor who has lived through prior downturns, such as the 2008 2009 financial crisis and the volatility of 2020, can provide perspective grounded in real world experience. Living through these periods teaches how people actually behave under stress. Theoretical solutions often look very different when emotions enter the equation. Human judgment remains essential in translating information into practical advice and in helping clients stay disciplined rather than making impulsive, costly decisions. And keep in mind, the same debate has happened before. The idea that technology will replace financial advisors is not new. Similar predictions emerged more than a decade ago with the rise of robo-advisors and online trading platforms. At that time, many believed automated tools would eliminate the need for human guidance. If a computer could build and rebalance a portfolio, what role would an advisor play? Yet advisors did not disappear. In fact, demand for comprehensive financial planning has continued to grow, with many robo-advisor platforms now employ human advisors to address complex planning needs and the emotional aspects of managing wealth. Technology improved efficiency, but it did not replace thoughtful guidance. The same pattern is unfolding with AI. Advisors who embrace AI can enhance their work by saving time, improving analysis, and delivering better outcomes. Those who ignore it risk falling behind. This dynamic is not unique to finance. It applies across professions such as law, accounting, and actuarial science. The professionals who embrace this new advancement in technology will succeed. The people who shy away from it will make themselves antiquated. So, what should investors do? For individuals managing their own finances, AI can be a useful part of the process. It can help clarify terminology, explore ideas, and identify areas for further research. However, relying on it exclusively is risky. The information may be incomplete, overly generalized, or simply incorrect. If you ask AI about a topic that you already understand well, its limitations become crystal clear. Self-directed investors must still verify information, consult multiple sources, and carefully evaluate how general advice applies to their specific situation. A more prudent approach is to work with a qualified professional who can interpret information within the context of your life and your goals. Financial decisions often have long term consequences, and there's no substitute for personalized guidance. Managing wealth involves judgment, experience, emotional intelligence, along with deep understanding of individual circumstances. And these qualities remain firmly human. AI will continue to evolve and improve. It will become an increasingly powerful tool for both investors and advisors. However, it's not a replacement for thoughtful, experienced guidance, at least for now, and likely for the foreseeable future. The most effective approach is a combination of both leveraging technology while also relying on human insight where it matters most. Okay, those are the talking points this week. As a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Richard Nixon. For those who don't know, Richard Nixon was the 37th President of the United States, serving from 1969 to 1974, and he's noteworthy for major foreign policy achievements such as opening diplomatic relations with China, advancing the détente with the Soviet Union, and negotiating the Paris Peace Accord that ended direct U.S. involvement in Vietnam. Domestically, he created the EPA, expanded civil rights enforcement, and signed landmark environmental laws. His presidency is equally defined by the Watergate scandal, which I'm sure everyone's heard of, which led to his resignation, the only one in U.S. history. Nixon remains a complex, consequential figure whose legacy blends the strategic accomplishments that I listed with the profound political controversy with Watergate. Nixon once said in an interview, the unhappiest people in the world are those in those in international watering places like the south of coast of France, Newport, Palm Springs, and Palm Beach, going to parties every night, playing golf every afternoon, then bridge, drinking too much, talking too much, and thinking too little. Retired with no purpose. Well, I know there are those who will totally disagree with this and say, boy, if I could only be a millionaire, that would be the most wonderful thing. If I could just not have to work every day, if I could just be out fishing or hunting or playing or golf or traveling, that would be the most wonderful life in the world. They don't know life. What gives life meaning is purpose, a goal, the battle, the struggle, even if you don't win. Nixon's quote warns that life built solely around leisure eventually hollows out a person's sense of meaning. His point is that humans are wired for purpose, challenge, and contributions. When those disappear, unhappiness creeps in, despite comfort and abundance. For retirement, especially, the quote argues that joy comes not from escaping responsibility, but from replacing work with meaningful pursuits, learning, service, creativity, community, and anything that gives structure and significance to the day. And this is why I always caution so many retirees that they need to retire to something, not from something. Doing the DOF and visiting your grandkids are worthwhile activities, but they're not sufficient to fulfill your purpose. There needs to be something else like volunteering, part-time work, or other activities that really enjoy life, that really help people enjoy life. People are meant to work, not wither away at the beach or the golf course. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. Okay, first question. I make a lot of money on OnlyFans. No judgment here. Any advice on how to best handle my finances with this setup? Yes, I do have some advice to impart. Since OnlyFan creators are considered independent contractors and typically receive 1099s because they run their own business, you are responsible for your own taxes, including self-employment tax. Make sure you hire a competent accountant to help you with this. Additionally, the solo 401k is often the best all-around choice for high savings with flexibility because you have Roth versus traditional options, while a SEP IRA is great for maximizing contributions in high-earning years. And a standard Roth or traditional IRA offers simplicity and flexibility for lower incomes, potentially layered with a solo 401k. The ideal plan depends on your income, price sensitivity, and willingness to deal with administrative related matters. The last point worth considering is in terms of consistency of income. I'm not too familiar with how sustainable the business model is for creators on OnlyFans. Perhaps your fan base becomes less enthused with your content and migrates to other creators or other platforms. For this element of uncertainty, which may be more relevant to your career versus other career trajectories, I would encourage you to always maintain a couple years worth of cash on hand in case you hit a speed bump or lose your fan base. If you're Zocha to be making a tremendous amount of money now, you may want to save heavily for your future, pay off debt, including your mortgage, and take other precautionary financial measures so you are prepared if your business is no longer sustainable. Next question. The yeshiva I work at has a pension that contribute the maximum amount. The issue is that there is no guidance to help me pick investments. Also, the investment firm running the plan pushes most of their company's funds into the investment options. I'm wondering if this is a standard for all pensions where there is no one giving advice on how to invest. The firm running it pushes their own mutual funds. I'm also clueless about fees. Thanks. I feel like this question has come up a few times. Obviously, you can feel free to reach out directly to me if you do work or an organization and are concerned about their plans and you feel I can help. But we'll dig through it again because it's obviously an important point. We'll go through it at a high level. Many yeshiva employees do face confusion about the retirement plans, so it's worth clarifying how these plans work and what you should expect first. Most yeshivas offer 403b or 401k, which are defined contribution plans where employees choose their own investments and the money belongs to them from the onset. This differs from a pension, like you incorrectly referenced, which guarantees lifetime income and places investment risk on the employer. Due to this risk and costs, pensions are rarely used today. Therefore, I assume you're referring to a 403b or 401k plan. A well-run 401k or 403b plan relies on three independent professionals together. First, there's a custodian who holds and safeguards the asset, processes the contributions and withdrawals, and executes trades, and provides statements. Fidelity, Voya, Transamerica, and Vanguard, etc. are all options. There are many more as well. The second is the TPA or third party administrator. They handle compliance, plan documents, annual IRS DOL testing, employer contribution calculations, and Form 5500. And finally, number three, financial advisor. This is where I fit in. We oversee investments, monitor fees, maintain the investment policy statement, runs annual education meetings for employees, and supports fiduciary oversight. These three roles must be three separate entities in order to avoid conflicts of interest. A custodian recommending only its own funds is a red flag. A TPA recommending investments or a custodian is also a red flag. A financial advisor recommending funds his firm manufactures is also a conflict of interest. Guidance should come from an independent advisor who does not work at the firm that manufactures financial products. A strong plan also offers open architecture, meaning a diverse lineup of mutual funds from multiple fund companies, plus target date funds for hands off investors. While 401ks can't be customized for every individual, a broad, low cost menu is a positive sign. Another point worth mentioning is that fees can be opaque, so the advisor should benchmark all plan costs annually to ensure competitiveness. These fees should be transparent and readily available for the plan sponsor to see and review annually. Ultimately, the Yeshiva's leadership has a fiduciary obligation to serve providers, compliance, and documentation. If you're concerned about your plan, you can Aleph, raise the issue with the executive director, CFO, or HR. Bays, suggest an independent review. Gimel, review the report that should outline strengths, weaknesses, and improvements. Many independent advisors who run these types of plans should be able to do a review to see if anything is in line with industry norms. I don't charge for these types of plan audits, but I can't speak for others. Remember, a properly run retirement plan should incorporate regular education meetings for employees, transparency, and strong oversight. This is an essential service for Rebbeim, Moras, and teachers who devote themselves to educating and inspiring our youth to live a life of Torah. Don't cut corners on these plans. Next question. Do you believe plastic surgery offers a good ROI? And another one, I believe I've spoken about this before with a Shaila, probably 4 years ago at this point, about a mommy makeover. I guess if the Olam is re-asking this question, it's time for some chazara. Let's start by stating a fundamental point, which is that personal finance is all about trade-offs. One could go out to nice dinners a few times a week, but they may not be able to save as much for retirement. Similarly, if the mommy makeover is something that will bring joy to your wife and is a prudent financial and medical decision, and you are both okay with the trade-offs of not being able to use that money elsewhere, like a vacation, a makeover of your kitchen, or sponsoring your son in Kollel, then go for it. To quote the Talmud Yerushalmi, a happy wife makes a happy life. This quote should serve as your North Star and guide this decision and every decision you make in life. Next question. You mentioned that the best way to save up for long-term smachot is by placing your money in a taxable investment account. What I personally have been doing is putting money away monthly in a New York 529 account, and my thinking is that when the time comes to make weddings, I will need to pay for college too, so the money that I am saving for weddings, I'll use to pay for tuition at that time when I'll use my regular money. I'll pay for wedding. What are your thoughts about this? The first thought that comes to mind here is this. What you talking about, Willis? This question is incoherent, and I'm not rereading it for a third or fourth time to try to decipher what you're trying to say. That being said, saving in a 529 account for a wedding is wrong, ill-advised, and just plain stupid. If you take funds in a 529 account, they'll need to be used to pay for higher education, or you'll get taxed and penalized if you don't do that. There are a few small exceptions to this rule, but throwing a simcha at Marina Del Rey is not one of them. Unless, of course, you are Hamish enough to write down the whole wedding was actually a higher education experience, which is also an accredited approved program for accepting 529 funds. I imagine this suggestion, which was made in jest, of course, gave an idea to a lot of Hamish people trying to find out a workaround. These same Hamish people are also the folks that will make up the minion at Otisville at some point in their lives. Next question. I listen to a podcast and read a blog, and the host slash blogger is almost always promoting firing your financial advisor. He says everyone should manage their money themselves. Is there merit to this philosophy? No, there's no merit to this argument for most people. Sure, there's a small group of people who spend hours every day, every week, obsessing over personal financial content. But this is not most people who have full-time jobs, families, and hobbies. The blogger slash podcaster you describe is a modern day snake oil salesman. You just need to buy his courses, his books, subscribe to his channel, click on his affiliated links, or whatever else he's selling, and all your financial problems are magically solved without the help of a professional. It's a fairly absurd proposition for most families who need real advice catered to their specific needs. Buying a course and the SPY or the S&P 500 will not solve most people's financial challenges. At the end of the day, it's always helpful to know what people are selling, to understand their biases. Everyone has biases, and this is especially true with modern day financial snake oil salesmen slash influencers who make money by selling ads or courses. Try not to be brainwashed by these people. It will not help you out in the long run. His course and books are not all encompassing and need to be generic in nature. Most people who buy into this approach will end up finding out the hard way how much they were missing along the way. Sad. Thoughts on Airbnb as an investment? My colleague has a few Airbnbs and seems to be doing really well. So if you're not in the real estate business, not as if you're in the real estate business, I should say, not as a dabbler, but as a full-time professional, then it may turn into a good investment. It may not, but there is the possibility. If you are a dabbler, then don't bother. It will be a huge hassle, require tons of maintenance, given the quick turnover of tenants, zoning issues that prohibit Airbnb that may come up, and other headaches. If this is your full-time job and you could deal with the hassle, work, cost, risk, you may make a decent amount of money. Alternatively, you could stick to liquid stocks and bonds, have less stress and risk in your life, and have a higher probability of making a lot of money. My guess is your colleague gets his kicks out of owning an Airbnb, but net of expenses doesn't make as much as he thinks and probably has elevated his blood pressure because of the stresses I mentioned. This should not be super appealing for most people, especially if they work full time outside of real estate. When it comes to successful investing, you need to be realistic. Next question. If I'm placing money in a 529 account or an UPMA account, what impact will it have on my ability to receive financial aid? If any, what significance should I give to that? Unfortunately, neither are good for applying for financial aid. When applying for college financial aid, the impact of a 529 plan depends largely on account ownership. Under FAFSA rules, financial aid formulas weigh income more heavily than assets and assess parent and student assets differently. A parent-owned 529 with the student as beneficiary is reported as a parent asset and assessed up to 5.64% of its value, with distributions excluded from income, making it relatively aid-friendly. A student-owned 529 often arises from custodial accounts that is treated as a student asset and assessed 20%, significantly reducing aid eligibility. Recent FAFSA changes make grandparent-owned 529 especially favorable. They are not reported as assets, and distributions no longer count as student income. However, many private colleges using CSS profile apply stricter rules and may count all 529s more aggressively. Overall, parent-owned 529s have a modest effect. Student-owned accounts are disadvantageous, and grandparent-owned 529s are now optimal for FAFSA-only schools. On the other hand, a child's UTMA account can significantly reduce college financial aid eligibility because it is treated as a student asset, which is assessed more harshly than parent assets. As I previously mentioned, under FAFSA, student assets are assessed up to 20% annually, meaning a $50,000 UTMA can reduce aid eligibility by up to $10,000 per year, regardless of use. The CSS profile is often even less favorable. UTMA assets cannot be retitled, may trigger taxable capital gains when sold, and receive no special aid treatment, making early planning essential. Zooming out a bit, you shouldn't structure your financial life just to ensure your kid gets the most financial aid. That is short sighted and silly. Instead, I would spend time and effort to figure out how to spend as little time in undergraduate school, which is for most people a total waste of money. For a fraction of the price, you can get an accredited online bachelor's degree in a few summers, lock it up, save the money, move on to the next facet of your life without digging yourself into a huge financial hole while also exposing yourself to a hostile environment for Jews, both physically and spiritually. Next question. I'm a surgeon and very concerned about protecting my assets in case someone sues me. Any suggestions? Good, Shyla. Let's take a quick step back, as I like to do, for some background for readers or listeners to this podcast. So, asset protection planning involves legally structuring ownership of assets to shield personal and family wealth from lawsuits, creditors, judgment, and unforeseen liabilities without engaging in fraudulent transfers. Many physicians already practice basic asset protection through umbrella insurance, malpractice coverage, and holding investment or rental properties in LLC. The challenge is moving beyond these basics towards more integrated, proactive planning. Several trust structures are central to modern strategies. This includes, and I'm going to list a bunch of them here, one, spousal lifetime access trust or a SLAT, which allow one spouse to fund an irrevocable trust benefiting the other, reducing estate and creditor exposure while preserving indirect family access. Proper drafting is critical to avoid IRS scrutiny under this reciprocal trust doctrine. Two, domestic asset protection trust or DAPS, available in certain states, permit self-settlement trusts with creditor protection, but their effectiveness may be challenged if the physician rides in a non-DAP state or funds the trust too close to claim. Three, an alternative option gaining attention is the special power of appointment trust or a SPAT. Here, the physician is not a beneficiary but a third party that can direct distributions, offering protection without the legal risk of self-settled trust. Four is an incomplete gift trust are increasingly used to preserve a step up in tax basis at death while still provided creditor protection, which is important for physicians whose estates are below federal tax thresholds but heavily invested in appreciated assets. Five, keep in mind that trust assets alone are not sufficient. LLCs remain essential for segregating risk related to practices, real estate investments, while number six, insurance-like practice, malpractice, umbrella, D&O, also serve as the first line of defense. In summary, for physicians, effective asset protection is proactive, multidisciplinary, and individualized. It requires early planning, careful entity and trust design, and close coordination among legal, tax, and financial advisors to protect your assets while maintaining flexibility for family and career transitions. Next question. I'm selling my business in 2026 for a decent sum of money. I'm concerned about taxes. My broker said I can borrow money against my portfolio to pay taxes. Thoughts on this? My thought is your broker is suffering from some form of feeble-mindedness, doesn't understand risk, has his own agenda which does not align with yours, and you should not adhere to his quote-unquote advice. Unless you're a multi-billionaire who's financing his life through borrowing against their large public stock position so they don't lose control of their company and are ungodly wealthy, then this approach doesn't make sense. Anytime one borrows money, they are taking on risk. Ask yourself if that's what you want to do at this stage of your life. Do you want to take more risk or collect your winnings after taxes and move on with the next facet of your life? For most people, it should be the latter. Paying taxes sucks. Trust me, I have firsthand experience with paying taxes and I hate it. There are some things you can do to lower your tax liability. These may include selling your business over the course of a few years, equity sale versus asset sale, installment sale, earnouts, QSBS section 1202 if eligible, purchase price allocation, and others, all of which require hiring a competent attorney and tax advisor. All that being said, your financial advisor should not be the one advising you on the tax efficient way to structure the sale of your business. That's for the other professionals I mentioned. It reminds me of the insurance salesman or financial advisor that says they do estate planning for you. No insurance person or financial advisor does estate planning. They can sell life insurance, but that's a big difference. The advisor can and should be brought in later to help implement estate planning strategies, manage risk, and manage the proceeds based on your goals. Understand which professionals to go for different situations is key. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, please feel free to reach out directly to me, and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I like to end with a timely and actionable idea that listeners can implement to their own financial lives. And today's timely idea is tax traps to avoid. In particular, we're going to discuss why your asset location may be backwards. Asset allocation, how much you hold in stocks versus bonds, gets all the attention. Asset location, which accounts hold those assets, usually gets none. Say you hold $200,000 in taxable bonds throwing off 5% interest of $10,000 a year inside a regular brokerage account taxed at 24% tax bracket. That's $2,400 a year in tax you wouldn't owe if those bonds sat in your IRA instead. Meanwhile, the tax-efficient index fund sitting in that IRA would have cost you almost nothing in a taxable account. Swap the two, and you keep $2,400 every year going forward. That's usually a one-time fix you can make in an afternoon with your statements in front of you. I'm not saying that you shouldn't take everything into account, and sometimes bonds do make sense in an IRA. Oftentimes it may make sense. But keep in mind that you want tax-efficient investments in taxable accounts and tax-inefficient investments in your tax-advantage accounts. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.